The quiet Sunday evening was shattered by a price spike of historic proportions. On the electronic trading platform known as Globex, where futures contracts trade after the formal market's close, the price of silver did not simply rise, it exploded. In a flash, it traded at $106.55. This was not a gentle nudge higher. It was a violent upwards dislocation, a market event that, in its sheer force, signals a deep and fundamental crack in the foundation of a system many assume is stable. This is a story about that crack. It is a story about two separate worlds that are supposed to share one price, the world of paper promises and the world of physical metal, and it is a story about what happens when the tension between them finally becomes too great to contain. To understand why this event is so significant, we must first understand the official action, the mechanism through which the world is told the price of silver. That mechanism is the futures market, specifically the one run by the CME group on the COMEX. This is the official scoreboard. When financial news reports the price of silver, this is the number they are citing. It is a price discovered through the trading of contracts, legal agreements to buy or sell a certain amount of silver at a specific price on a future date. The vast majority of these contracts are never intended to result in the actual movement of metal. They are financial instruments used by banks, hedge funds, and speculators to bet on price direction, to hedge other risks, or to provide market liquidity. The system operates on a premise of liquidity and trust, the promise that a contract will be honored, either in cash or, if demanded, in physical metal. This market is colossal in its trading volume. Billions of dollars worth of paper silver change hands every day. This volume creates the illusion of abundant supply. It allows for smooth price discovery, or so the theory goes. The price on the COMEX becomes the reference point for the entire global silver ecosystem. From miners selling their future production to jewelers sourcing material, this paper price is the anchor. The Sunday night spike on Globex is a direct challenge to that orderly process. Globex is the after-hours electronic extension of the COMEX. When the floor traders in New York have gone home, Globex remains open, allowing trading to continue across global time zones. But the liquidity, the number of active buyers and sellers, is much thinner. It is a market running on a skeleton crew. So, when a large buyer emerges in this environment, the results can be dramatic. The spike to $106 tells us one thing with absolute clarity. At the moment that buy order hit the system, there were not enough sellers willing to provide metal, even paper metal, at the previous price. The price had to leap forward to find a level where someone was willing to take the other side of the trade. This is not normal behavior for a deep, liquid market. It is the behavior of a market under acute stress. It suggests that the normal suppliers of liquidity, often large banks known as market makers, were either unable or unwilling to absorb that buy order at the prevailing price. This matters because the official price is the bedrock of global trade in this commodity. If that price can be gapped violently higher in a thin market, it calls into question the stability of the entire pricing structure. It reveals that the smooth, liquid facade of the paper market may be just that, a facade, behind which pressures are building that can no longer be smoothly contained. This event is a signal flare, illuminating a profound disconnect between the paper representation of silver and its physical reality. That disconnect is the core of our story. We must now contrast these two worlds, the paper market and the physical market. They are increasingly becoming separate universes, linked by a name but little else. The paper market, as we have discussed, is a realm of digital entries and financial settlements. Its sheer size is its defining feature. Each day, volumes are traded that represent many times the annual global mine production of silver. This volume creates noise, a constant churn of speculation that can drown out fundamental signals. The physical market, however, is a world of tangible weight and finite supply. It is the world of industrial fabricators who need silver paste for solar panels. It is the world of electronics manufacturers who need silver for conductive inks. It is the world of mints producing coins and of individuals who take delivery of bars, holding them in their hands. In this world, you cannot create 1,000,000 ounces with a keystroke. You must source it, refine it, ship it, and store it. And for years now, the signals from the physical market have been screaming scarcity, while the paper market often seemed to ignore it. The most glaring symptom is the premium. The price of a 1-ounce American Silver Eagle coin or a 1-kilogram bar is not the COMEX spot price. It is the spot price plus a premium. That premium covers minting costs, dealer margins, and distribution. But in a balanced market, it is relatively stable. For years now, that premium has been elevated and volatile. It is not uncommon to see physical products trading for $4, $6, or even $8 over the reported paper spot price. This is a direct market signal. It tells you that the actual metal, in the form people want to hold, commands a higher price in the real world than the paper contract does on the screen. This is the first major crack. The second is time. Delivery times for certain products have stretched from days to weeks or months. This indicates supply chain strain, a logjam, where demand for finished physical product is outstripping the mints and refiners' ability to produce it from raw material. The physical market is sending a clear, consistent message. There is a shortage of metal in the forms that end users demand. The paper market, with its infinite digital supply, has, until now, largely shrugged. The Sunday night spike may be the moment the paper market was forced, if only for an instant, to listen. It was a glimpse of the physical market's urgency intruding into the paper realm. When a buyer on Globex was willing to pay $106 to secure a futures contract, it may have been a hedge against the fear of not being able to find the physical metal at all tomorrow. The two prices, paper and physical, are set in different arenas with different rules. Their growing divergence is the central tension of this entire narrative. To comprehend the source of that tension, we must investigate the vault, the crucial and often misunderstood link between the paper promise and the physical metal. Within the COMEX system, there are two key categories of silver inventory. Eligible silver is metal stored in approved vaults that meets exchange standards but is not necessarily for sale. It could be held by an investor, a fund, or a sovereign nation simply using the secure storage. Registered silver is the heart of the delivery mechanism. This is metal that has been placed into the exchange's warrant system, making it officially available for delivery to settle a futures contract. This registered inventory is the liquidity pool for the entire paper market's claim on physical metal. The trend in this number is perhaps the most critical data point in the entire silver equation. Over the past several years, the registered category has experienced a sustained and dramatic decline. From heights measured in the hundreds of millions of ounces, it has fallen to levels now measured in the tens of millions. At times, it has hovered near lows not seen in decades. This means the buffer, the stockpile of metal explicitly earmarked to back the paper promises, is shrinking. Meanwhile, the open interest, the total number of outstanding futures contracts that represent promises to buy or sell silver, remains high. This creates a simple mathematical ratio, the number of ounces of deliverable metal in the registered vaults versus the number of paper ounces represented by open contracts. When that ratio becomes too thin, the system enters a state of vulnerability. It suggests that if even a modest percentage of contract holders decided to stand for delivery rather than settle in cash, there might not be enough metal in the registered vaults to fulfill those requests. This is not a theory. It is an accounting reality. The vault data is the balance sheet of the paper market's physical legitimacy. A declining registered inventory, in the face of persistent demand, indicates that metal is leaving the financial system and entering the hands of end users who do not intend to lend it back. It is going into solar panels, into electronics, into strategic national stockpiles, and into strong hands that simply want to own it permanently. Every ounce that leaves the registered category makes the paper market that much more precarious. The Sunday night spike can be seen as a market reflex, a sudden lurch in price that acknowledges this tightening physical noose. When the available deliverable supply is low, the market becomes like a dry forest. It does not take a large spark to create a significant fire. The natural question that follows is one of motive. Why would large financial institutions, particularly the bullion banks that are central to this market, allow such a situation to develop? It is essential to approach this from a neutral operational standpoint. These banks play several roles. They act as market makers, providing liquidity by being willing to buy and sell. They facilitate hedging for mining companies, who sell future production to lock in prices. They also take speculative positions based on their market views. In the course of these functions, they often accumulate large short positions in silver futures. A short position is a bet that the price will fall. From a purely operational perspective, these short positions can be seen as a natural byproduct of their role. When a mining company wants to hedge, a bank takes the other side, effectively going short against the miner's future production. This is a legitimate service that provides stability to producers. However, the scale and concentration of these short positions have long been a subject of scrutiny. The concern, from a market structure viewpoint, is that these positions are so large they can influence the price discovery mechanism itself. If a handful of entities hold a dominant share of the short side, their collective actions to manage their risk by adding to or covering shorts can create waves in the market that have little to do with physical supply and demand. Their motive, stripped of any narrative, is risk management and profit. If they are holding a large short position and the price begins to rise sharply, they face mounting losses. They must then decide whether to buy back contracts to close those shorts, which would push the price higher, or to sell more contracts to try to cap the price increase, which increases their risk exposure exponentially if the rally continues. It is a high-stakes game. The fines paid by some institutions in recent years for practices like spoofing, which involve placing fake orders to manipulate prices, are a matter of public record. They demonstrate that the regulatory bodies have identified and punished improper conduct in these very markets. So the institutional motive in the wake of a spike like the one to $106 is not monolithic. It is a calculus of risk. Some may see the writing on the wall of physical scarcity and begin to reduce their short exposure. Others may judge that the physical tightness can still be managed within the paper paradigm and attempt to defend their positions. This internal conflict among large players itself adds to market instability. Their actions are not driven by a desire to suppress or elevate price as an end goal, but by the cold, factual imperative of managing their balance sheets in a market that is sending profoundly mixed signals. Amidst this structural tension between paper and physical and the complex motives of large institutions exists the retail investor. Their experience is often one of profound frustration and psychological whiplash. They see the compelling fundamentals. They read about the annual supply deficit, the soaring industrial demand from green technology, and the shrinking vault inventories. They buy physical metal, paying a steep premium over the reported spot price, believing in the long-term value proposition, and then they watch the paper price on their screens, the official price, get pushed down in a wave of selling that seems disconnected from those fundamentals. This creates a deep sense of distrust. It feels like the game is rigged. The emotional toll is significant. They are told they are wrong by a price signal that they increasingly believe is false. They are labeled conspiracy theorists for questioning why the price does not reflect the data they can see with their own eyes. They watch their investment stagnate or decline, even as they struggle to find physical product to buy at any price. This psychological disconnect is a powerful feature of the market. It leads to apathy and surrender. Many simply give up, selling their metal out of frustration, providing the physical supply that the market desperately needs. Others become hardened stackers, ignoring the paper price entirely and focusing solely on accumulating ounces, a practice known as sound money. The Sunday night spike to $106 is a moment of profound psychological vindication for those who have held through the doubt. For a brief moment, the paper market acknowledged the pressure they have felt in the physical market for years. It is a flash of alignment, but it is also a trap. The immediate emotional response might be one of euphoria and a fear of missing out. The danger is in chasing that spike, in buying into a moment of extreme volatility without a plan. The retail psychology is the human fuel in this engine. Their collective actions, whether driven by fear, frustration, or conviction, create flows of physical metal and paper contracts that the larger players must then contend with. Their willingness to take delivery, to say no to cash settlement, and demand the metal is the ultimate check on the paper system. It is the one action that forces the two separate worlds to collide. Where does this leave us? We have a documented supply deficit. We have a paper pricing mechanism showing signs of acute stress, as evidenced by the violent spike to $106 on thin liquidity. We have a physical market that operates at a persistent premium, indicating scarcity. We have vault data showing the buffer stocks for delivery are at historic lows. We have large institutions with complex motives managing enormous risk positions. And we have a global audience of investors caught in the middle, trying to discern truth from noise. We cannot offer advice, but we can outline scenarios based on the evidence presented. One scenario is a continuation of the status quo. The paper market, through its immense volume and the actions of liquidity providers, manages to reassert control. The spike is faded, the price is pushed back into a familiar range, and the physical premium remains as a release valve, a hidden cost borne by those who insist on real metal. The disconnect persists, held together by financial engineering and inertia. A second scenario is a gradual convergence. The paper price begins a sustained grind higher, slowly catching up to the realities of the physical market. Industrial users, facing real procurement challenges, bid up futures contracts to secure supply, forcing the paper market to acknowledge the fundamental deficit. This is a path of steady revaluation. A third scenario is a violent convergence, a snapback event. This is what the Sunday night spike may have been a warning shot for. In this scenario, a catalyst, perhaps a geopolitical event, a major industrial buyer panic, or a sovereign nation making a large strategic purchase, triggers a wave of delivery requests on the COMEX. With registered inventories so low, the system cannot fulfill them in an orderly fashion. The result could be a forced short squeeze of historic proportions. The paper price would surge violently as those with short obligations are forced to buy back contracts at any price. This could lead to a moment where, for a period, the paper and physical markets find a new, much higher equilibrium point, a price that truly clears the market and rations the remaining metal to the highest priority users. The final scenario is one of systemic change. If the paper market is repeatedly shown to be broken, trust in it as a pricing mechanism erodes. Buyers and sellers could begin to transact purely on bilateral agreements, referencing physical benchmarks and ignoring the COMEX spot price altogether. The official price would become irrelevant, a ghost of a system that failed to adapt. The spike to $106 is a data point, a profound and shocking one, but a single point nonetheless. Its true meaning will be determined by what happens next. Does the physical metal continue to drain from the exchange vaults? Do the premiums on coins and bars widen further? Does the industrial demand from sectors like solar power continue its exponential growth? The evidence suggests we are in uncharted territory. The rules of the past are being strained by the facts of the present. The two worlds of silver, paper, and physical cannot remain divorced forever. Their reconciliation, when it finally comes, will define the next chapter in the long and turbulent history of this metal.